Hey everyone, it's Patrick here. I just wanted to take an opportunity to talk to Oli about Bob Farrell and his 10 trading rules. We were reviewing them for the purposes of applying them to today's markets. And when reading it, I just thought it was so relevant to have the conversation and just to get everyone refreshed again on these amazing rules that have stood the test of time for over 50 years. So let's talk about Bob Farrell. He was a technical analyst at Merrill Lynch back in the day, and he had 50 years of trading experience and put these together, and we still use these rules today. So number one, markets tend to return to their mean over time. And this is such an important rule because we see market excesses all the time. And this is because of herding of investors. Investors chase performance and chase the stories that are hot. And what ends up happening is that these stocks become way overvalued, go way too far. And ultimately, when that euphoria ends, the stocks mean revert back to their true fundamental values. This happens and it clouds people's judgments. And in the end, these trends will last much longer than most people anticipate, feeling that they will never end, but they always do. Number two, excesses in one direction will lead to excesses in the opposite direction. Think of it like a rule of reflexivity or like a bungee cord. Imagine someone jumping off a bridge with bungee cord tied to their feet. The size of the bungee cord and the amount of momentum they have to the downside will directly result in how far they go. But inevitably, when the bungee cord tightens far enough, the reflexive snap back the other way has direct proportion to the magnitude of the first move. And in this applies to the stock market. So when a stock shoots higher in a really big way, you will have this big overshoot, and then it will mean revert, and often that move will be of similar and relative proportion to the same move that brought it on the way up. Number three, there are no new eras. Excesses are never permanent. Can't think of a better example than the internet boom in 1999, or what is now the AI boom currently in 2024. And when you go back to using the 1999 analogy, you had everyone realize that the internet was going to change the world. And investors felt that they had to be invested in this. And so they bought anything and everything with a .com at the end of it, thinking that if they didn't get in when at the beginning phase, that they would miss out. And they paid ridiculous prices for these securities. And in the end, the internet did change the world, but the excesses of the valuations on those internet companies just never stayed. And many of them either went bankrupt and or lost 90% of their value on pullbacks along the way. No better example of that is Amazon. Amazon today is one of the largest companies in the world, and anyone in 1999 that was buying Amazon on that vision was dead right. But from the year 2000 to 2003, Amazon lost over 90% of its value from its peak and took almost 5, 6, 7 years to legitimately start to rally again. The point is that there are no new eras. Excesses are never permanent. Number four, exponentially rising or falling markets usually go further than you think, but they never correct by going sideways. And the best analogy to offer is that of a model rocket. It has a certain amount of fuel in it, and it shoots up into the sky. And how much fuel's in that rocket and how far it goes can surprise you. But at some point when the fuel runs out, gravity takes over, pulling it right back down to the ground. It doesn't just stay up in the air. The markets are exactly the same way. And so when these stocks make these big exponential moves, think of Tesla a few years back, or what is NVIDIA is doing today. And you can name any number of stocks like silver in 2011 or nickel a few years ago. There's all these markets that do the same exponential rises, but they never correct by going sideways. So you can always participate in these types of bubbles, but know that when the music stops, you got to have a chair and know when to get out. Number 5, the public buys the most at the top and the least at the bottom. And this is a very important rule to remember. When you consider yourself an average investor, by the time you get to hear the story, know the story, and everyone's talking about it at your local club, and everyone gets excited about it, you are already at the euphoria stage of a stock, where the stock is the center of everyone's attention and is building momentum from just the fact that everyone is interested in it. When a stock is at its bottom, nobody cares. Nobody wants anything to do with it because it's not interesting. And investor psychology is so important in that element. The most important thing to remember is you're always trying to assess the asymmetry of an opportunity. And the asymmetry is, where can I take the least amount of risk to take and get the most upside potential? And the biggest obstacle for being a general retail investor, that often is we refer as the public, is that you end up buying high on the stories that are already well in play, because it's the exciting story that the media and the news and everyone is hyping. It's all over social media. But by then, it's already getting to the later stages, like you think of it like a 7th or 8th inning of a game. Remember, the public always buys the most at the top and the least at the bottom. Number 6, fear and greed are stronger than your long-term resolve. And this is such an important rule to remember. So many people say, well, look, even if a stock pulls back, I own it. I'll hold it over the long term. Everything is fine. And it'll always come back. But what shocks everybody is how much pain they start to feel when they see a security start to go against them, and how often it causes investors to capitulate, particularly if a bad story associated with the security comes out. Recognizing that we naturally make decisions based on greed in the hope of making money on the upside, and then capitulate out of fear because of the preservation of capital being such an important factor. Number 7, markets are the strongest when they are broad and the weakest when they are narrow to a handful of blue chip names. This is where breadth is really important. Think of it like a tide rising in an ocean. All boats will rise when the tide is rising, and same with when it's receding. Markets work in these waves. When you have simply a few stocks that are driving the entire performance of the market and the rest of the stocks are not participating, it's not a healthy market. It's a market that has lots of vulnerabilities, and you should always be wary of that. Number 8, bear markets have 3 stages: sharp down, reflexive rebound, and draw out fundamental downtrend. And this is an important thing to remember. During bull markets, trends tend to have these quick little dips that are bought and rally, but bear markets are prolonged periods of correction. And you have a scenario where the first is the realization of this market, that the new bear market has begun, and it becomes a sharp and deep first sell-off. That led back to the rule of reflexivity, will bounce, and there will be a reaction in the market. But then after that reaction comes a long, slow bleed. When you're in these scenarios, you want to always be wary of holding on to something that is in a primary downtrend. Number 9, when all the experts and forecasts agree, something else is going to happen. This is one of my favorite rules. You want to think that when the public is fully invested, when all investors are fully invested, is when they all agree. But when everyone agrees that something is going to happen and they're all invested, who's the next marginal buyer? Ultimately, that's actually a point of exhaustion that will result in the market doing something different. There's a great saying that the market climbs a wall of worry. And in fact, some of the best opportunities are always when there's something to be skeptical about, and you're worried about something. It means that there's still opportunity and money to flow into the market. Number 10, bull markets are more fun than bear markets. And while there are many traders that try to trade bear markets and say, look at these amazing reactions that happen, the volatility associated with bear markets can be gut-wrenching. An example of the 2000 bubble in the NASDAQ, after the first very sharp decline in the NASDAQ, it rebounded 30+% on the upside before resuming the bear market. These kind of percentage swings are just very difficult to trade. While bull markets, there's that saying, the markets rise on an escalator and drop on an elevator. And it's so much easier to trade bull markets in general. So when there's a risk of a bear market, often the best thing to do is to reduce your exposures and reduce the overall volatility that you're experiencing in your portfolio. What's amazing is that these rules were written well over 50 years ago, and yet they stand true to this day. It's because the markets behave a certain way, because in the markets, it's price discovery of investors perpetually voting with their money, and they're choosing the securities and the stocks that they want to own and sell. And this cycle plays out over and over again. Even as internet and technology comes, maybe it speeds it up a little bit, but it's amazing that today the market works exactly the same way it did 50 years ago.